In this video, we're going to talk about Aterian, trading under the ticker symbol ATER. Over the past few weeks, Aterian has been the center of attention for both retail and institutional investors because it was the target of short selling and the target of short squeeze at the same time. We're going to look at how is the stock doing now, where the price action is tilting towards, and if you should buy the stock. Before today's video begins, if you like my content and would like to watch more stock analysis videos, please like, comment, and subscribe to my channel. Aterian is a consumer-oriented manufacturing and retail company. It sells home and kitchen appliances, beauty products, and electronics. Recently, the company has been the target of short sellers, who aim to borrow the shares from brokers, dump them into the market, and to buy them back later, with the expectation that the stock has gone lower. One of the key reasons why they're targeting Aterian is probably because the company's fundamentals were not that good over the past few years. Its operating losses went from $22 million in 2017 to more than $54 million in 2019. But the good news is that they went back to around $22 million in 2020. So not everything is that doom and gloom for the company. Another encouraging sign for those who are on the short squeezing side is that the company is having positive cash flow from its operations in 2020 for the first time since 2017, at $5.9 million inflow, even if most of it is due to an increase in working capital. The cash flow from operations is still negative, but it's about 1/10 of the cash flow deficit compared to previous years. So in terms of fundamentals, I think that things are improving for Aterian, and it's probably going to keep being the case for the next quarters and years ahead of us. Another very positive sign for Aterian is that despite the fact that the short sellers are trading up to 70% of the volume in dark pools in order to get the stock lower, its stock price doesn't go down. In fact, on October 11th, its price increased from $8 to around $8.80 before stabilizing around $8.50. In other words, there is a real possibility that the short sellers will not be able to push the stock further down, and eventually the retail traders will turn the tide in this. Of course, there's no guarantee in any of those scenarios. Everything that I'm saying here is dealt in probabilities only. But if we really think about it, as of right now, the short sellers cannot afford to wait. And that is because the more they wait, the more the brokers are going to charge them financing fees to keep their positions open in the first place. For retail investors who are long, there is no rush to get the positions closed, since the only costs would be the cost of opportunity and a possibility of incurring capital losses, both of which are also shared by the short sellers. I think that over the next couple of days, the stock is going to continue to keep going sideways, and it would be normal to see it going even a bit lower. But what's important here is to make sure that its volume remains high, between 10 million and 15 million shares. At some point, I believe that the short sellers may begin to let the position go, which will result in the stock price going higher. In terms of how much you should risk, I would suggest to keep the position between 1 to 3% of your portfolio and to take the profit once the stock price reaches $15, because that was the previous peak, and because I think that this is where the stock will likely peak in the short run as well. Now, looking at the current market environment, I believe that we have to be careful with having exposures in equity market. The market has been predicted to eventually go through a major pullback or recession for more than a decade, and that its future outcome largely depends on a number of elements. First of all, after the QE years and the drastic increase in asset price and the corresponding decrease of their yields, we got to remember that the market doesn't mirror the real economy. Otherwise, we would be trading a market that has gone sideways since 2008. And then 2000 2020 saw another big push, and then 2020 saw another big push in asset prices. And this time, not just for the blue chips, but also the growth stocks. There are, generally speaking, two explanations. The first one is that more money has been printed across the world, and because the real economy has been stagnating over the years, the capital then entered into the financing part and has been just buying up asset prices ever since. That was the case for about a decade, but now that QE is wrapping up in North America and in Europe, they're now slowing down and touching to like the end part. They will not necessarily be an important part in maintaining the stocks up in the years to come. This decrease in new money is partially compensated with the geopolitical tension around the world. And the more tensions there are, the more money tends to flow to the US and North America because it is perceived as a safe haven for capital from different countries, especially the ones that are currently seeing turmoil or social unrests. One last phenomenon is the attempt of market participants to protect their capital not just by remaining cash heavy, but to concentrate their purchases in a few specific sectors so that the asset price in those sectors remain high, not only due to good fundamentals, but because there is a high level of demand in the first place. What all of these mean for the market is that the degree of uncertainty will increase over the next couple of months and years, especially as the expectation for a recession builds up after the Great Party in 2020, and the recent announcements from US Federal about the possibility of this recession in the short term. These all contribute to a higher degree of inherent risks of owning shares. But of course, there also has been a buildup of economic difficulties coming from Asia, so the potential effects that it may have on our financial markets can be significant. All these elements led me to conclude that it's very important to keep the speculative plays like Aterian at a reasonable level. A healthy portfolio normally contains a good percentage of its positions in sectors that are very different and of classes and assets that are mostly in stable sectors with predictable cash flows. In other words, the mature sectors like REITs, fixed income assets, and preferred shares. The rest should be invested in growth stocks or just remain cash heavy in case there is an opportunity to scoop the bottom. Overall, I think that the current environment does make me believe that there will be opportunities to average down your cost basis in the future. But it doesn't really apply to Aterian, of course. I'm saying this across the board. And this is why I believe that the initial position should remain relatively small so that we can afford to average them down later, should it be the case. Now, again, in terms of Aterian, keep it small because the play is speculative, not necessarily because you want to average down necessarily. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.